Hi, and welcome to the eCIO market commentary for October. October was a mixed month for U.S. equity investors as the S&P 500 gained 2.3%, but the more value-oriented dividend index lost 2%, and the S&P equal weighted index, which is a broader market representation, lost about 1%. Overseas stocks were positive. Developed markets gained just over 1%, while emerging markets gained 4%, and fixed income results were also positive, up about 0.5%. That takes year-to-date results into strong positive territory for the S&P 500. Overseas stocks an eye-popping 25 to 30% returns year-to-date, and fixed income results up about 6 to almost 7%. It has been a volatile year as the S&P 500 returned 21.5% over the past 12 months and has now annualized a return of over 22% for the past 3 years. Volatility started in about mid-February on talks about trade and pending tariffs that culminated with the announcement of very significant tariffs in early April. And then you see this rebound caused by the administration backing off some of those extreme tariffs, negotiating some trade deals, and also very strong earnings, in particular from the technology sector. In fact, the technology sector led the S&P higher during the month of October and year to date. The month of October saw those stocks gaining about 6%. It was somewhat of a narrow market. As you can see, only 3 sectors outperformed the S&P 500 index, while you can see over here 5 sectors were actually in negative territory. So all in all, a mixed market for U.S. stock investors, as the S&P did gain over 2%, while the equal weighted index, which is more representative, lost about 1%. International markets, as we pointed out, were also positive, led by the emerging markets. Bond results were primarily driven by interest income. The Fed did cut short-term rates in October. However, longer dated rates really have remained unchanged. So the meeting at the end of October, the decision was a 25 basis point cut from the Fed. Important to note that the chair, Powell, did note that a December reduction is not certain. And in fact, markets coming into this cut were expecting a 90% probability of another cut in December. That's since dropped to about 60% based upon the comments from the chair. Inflation is the key concern for the Fed, and the CPI came out in October for the month of September, and that was reported at 3%. That is up from 2.9% in August, clearly moving in the wrong direction. The Fed's target is 2%, so there's a ways to go there. The government shutdown has gone on, as most of you know. The longer this goes on, the bigger the potential impact. Analysts are expecting that each week of shutdown could reduce quarterly GDP or economic growth by about 0.1 to 0.2%. So if it's not a long shutdown, there's not much impact. If this goes on for an extended period of time, there could be a much more significant impact there. During the month, consumer sentiment also stabilized. Spending has remained very resilient, in particular in the higher income household area, while we're seeing some weakness in lower and middle income households as they're actively seeking discounts to offset some price pressures and also the economic uncertainty. So looking forward, we think investors will be closely paying attention to the employment market. The Fed looks at that very closely in determining the interest rates. Consumer spending, obviously any action the Fed takes, the next meeting will be in December, so any comments that come from the Fed could have impact. The inflation numbers and economic growth signals, along with earnings reports, which so far are coming in very good for the quarter. And then last, of course, ongoing geopolitical risks persist and could have impact along with ongoing trade negotiations. So there'll be lots to watch over the next couple of months into the year end. So that concludes our brief report for the month of October. If your investment committee is interested in meeting with us, we'd be happy to do that. Just reach out. Thank you for your time and interest, and have a great day.